Financial Accounting 6A, Unearned Revenue, Gift Certificates, and we'll also cover Liabilities. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, St. Louis Test Prep. The email on the website and my book, Cost Accounting for Dummies, is out March of 2013, and we'll be teaching a free online course indefinitely, at least once a month. So the first topic I'd like to cover is unearned revenue, and gift certificates are a good example of unearned revenue. It's not just that somebody walks into a store and buys a gift certificate. The other part of what needs to happen is, in order to recognize earned revenue, you also have to consider that there's a time period during which the person who has the gift certificate can either redeem it or it expires. So they either redeem it, they come in and they buy something with the gift certificate, or it expires. At that point, you can recognize revenue. So unearned revenue at the end of year 2 in this example only relates to the year 2 gift certificates, and we're going to see an example of that here. So a company sells gift certificates redeemable for merchandise. The gift certificates expire 1 year after they're issued. They're good for a year. Here is information on gift certificate sales and redemptions at 12/31 year X2. So we had an unredeemed gift certificate balance at the end of the prior year X1. We had sales in year 2, 200,000. And then during year 2, we got redemptions. We got year 1 gift certificate redemptions, and we got year 2 gift certificate redemptions. And they know, based on history, that 10% of the gift certificates sold will not be redeemed, which means we need to wait until they expire before we can recognize gift certificate income. And so the question is, what is the unearned revenue on gift certificate balance at the end of year X2? So step 1 of our solution is to calculate the unredeemed gift certificates. So we're just looking at year 2. It's assumed that year 1 at this point has expired, just to keep it simple. So we have year 2 sales of gift certificates, and we have year 2 redemption, which means at the end of year 2 there are $50,000 worth of gift certificates that are not redeemed yet. And we're going to assume that into next year, which will be year 3, that people can still redeem them for good, so they're not expired yet. Step 2 of our solution is we compute the percentage of outstanding or unredeemed year 2 gift certificates that we don't think will ever be redeemed. So we take that $50,000 balance from step 1 of unredeemed gift certificates, and we multiply it by the 10%, which is the percentage we expect won't be redeemed, and we end up getting $5,000 is the amount that will never be redeemed. And so our unearned revenue is the 50,000 unredeemed gift certificates in step 1 less the number that we think will never be redeemed, 5,000, and we end up with unearned revenue for year 2 gift certificates of 45,000. So sales less redemptions equaled the unredeemed certificates, and then we took unredeemed and we multiplied it by 10% to get the year 2 unredeemed gift certificates that will never be turned in, and the net difference between the two of those is our unearned revenue. This next example is a little bit different. It's about a liability for unrefundable deposits. The easiest example is probably less so than it used to be, but turning in soda bottles to get a refund. It's usually printed on the label of the soda bottle. And here's the deal. The first thing to talk about is current liabilities. For the most part, accounting exams that I've seen stick with 1 year as the time period for current liabilities and current assets. However, the technical definition is current liabilities are expected to be paid within a year or the operating cycle, whichever is longer. But to keep it simple, most test questions use 1 year to mean current, quote unquote, whether asset our liability. So what should our liability ending balance be at the end of any period? Well, it should be the number of bottles that we sold multiplied by the amount of refund per bottle that people could get if they turned them in. Okay, example. A company operates a grocery store, and it's required by law to collect a 3-cent deposit on the soda bottles. And here's the information. So we have a beginning balance for year X1, 1231 XO, $100,000. We sell 5 million bottles during the year, and 6 million bottles get returned. Now that would be year one and years before year one. So we've got 2 years going on. Because customers are required to return the bottle within a year to collect the deposit. So during X1, some of the returns are X1 and some of them are XO. Here's a different deposit that's going on in the problem, which I thought was a good way to test this. During X1, the company leased space in a building they owned to someone else, and they received a $20,000 deposit. The deposit represents the last month's payment on the lease. The last month's deposit, which will be applied to the last year of the lease in year X5 when the lease ends. So we got money that represents the last lease payment. And if you ever signed a lease on an apartment or some other asset, you may have paid the same thing. So the question we're asked is about 2 different liabilities. What's the current and non-current deposits at the end of X1? And deposit is a liability because there's a likelihood we'll have to pay somebody back that deposit money. With the bottles, it's some vendor or some legal government entity, and with the lease payment, it would be paying back that last year of the lease. For some reason, the lease could be legally voided. So step 1 is to compute the ending balance of the bottle refund liability. So in X1, we sold 5 million bottles. The refund is 3 cents or 3%. So there's our refund liability for the bottles, and in red I say it's current because they're going to be refunded within a year. To get credit, they have to be refunded within a year. The step 2 of my solution is determine if the rent deposit is current or non-current. Since the rent deposit is for the payment of the lease in year 5, it's a non-current liability because it'll happen more than a year from now, which means it's non-current. So what we did was we calculated a liability for a deposit on the bottles, and we calculated a liability for a deposit on the lease. The bottle was a current liability, and the lease was a non-current liability. That's the end of Financial Accounting 6A. I have longer videos and spreadsheets, a half hour to an hour long, that are not on YouTube. If you know the YouTube channel, you can email me for a complete list of videos on YouTube. For live tutoring and chat sessions one-on-one, stltest.net is the website. And finally, the book Cost Accounting for Dummies is out March of 2013, and we'll have a free online course that'll be ongoing every month at least if you'd like to learn more. Thanks very much, and we'll see you next time.